Okay, before we jump in, just a quick reminder. This podcast episode is a general discussion based on one of our recent blog articles and should not be taken as financial advice. Welcome to Plouta, your go-to hub for financial well-being.
Hi, everyone. Yeah, our mission here is pretty simple, really. We want to empower people across the UK with clear, trustworthy insights.
Exactly, to help you take control of your financial future. So today, we're doing a deep dive into something that feels, well, almost ancient in market terms, but is incredibly relevant.
Absolutely. We're talking about Benjamin Graham's The Intelligent Investor.
Right, published way back in 1949, yet still seen as the book on investing. Even Warren Buffett calls Graham his mentor.
It's amazing, isn't it?
And we're looking at it through the lens of a great article on the Plouta blog, which explores these foundational ideas and shows how they actually apply to us, UK investors right now in 2025.
Yeah, the article does a brilliant job of that.
So the mission today, let's unpack this. We want to pull out the most important actionable bits from this classic guide.
And it's fascinating how these old principles, this wisdom, is maybe more crucial now than ever. Think about today's market. It's so fast, algorithm-driven, lots of noise.
So much noise.
Exactly. And what the article highlights, what Graham really taught, is that real investment success isn't about speculation or timing the market perfectly. It's built on discipline, proper research, and really understanding risk.
Yeah, cutting through all that modern confusion.
That's the idea. These enduring principles really help with that.
Okay, so let's kick things off with what Graham considered the absolute starting point.
Yeah.
The central, non-negotiable distinction.
Ah, yes. Investing versus speculating.
Can you break down that core difference for us? What did Graham actually mean?
Well, his definition is pretty stark, actually, he said. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return.
Safety of principal and an adequate return, okay.
Yes, and crucially, operations not meeting these requirements are speculative. Full stop.
So investing means, what, buying a bit of a business?
Precisely. You're buying a piece of a real operating business. Your success depends on how that business performs over the long term, its profits, its growth. It takes research, patience, focusing on what the business is really worth, its intrinsic value.
Right, and speculating.
Speculating is essentially betting on short-term price moves. Success there hinges on predicting which way the price will go, often based on market mood or, chasing the latest hot trend. Less about the business, more about the price tag on any given day.
And here's where it gets really interesting today, doesn't it? The article points this out. That line has become so blurred in 2025.
Dangerously blurred, I'd say.
Yeah, you see things like meme stocks.
Oh, definitely.
Or all the frenzy around certain cryptocurrencies, maybe those day trading apps that make it so easy to just jump in and out.
Exactly. And often it looks like investing. People might even call it investing, but when you strip it back, are they analyzing the business?
Right.
Or just betting on the price going up?
It really makes you question, what are people actually doing? Is it investing or just, gambling with a fancier name?
And this brings up a really important question for you, listening right now. Are you absolutely clear about the purpose of your financial actions? What game are you playing?
That's the intelligent investor's mindset, isn't it? You have to know.
You have to decide. Now, Graham wasn't totally against speculation. He acknowledged you could allocate a very small, completely separate pot of money to it.
Like a fun money pot almost.
Sort of, yeah. But only if you absolutely understand the huge risk and you're genuinely prepared to lose every single penny of it. Critically, though, your serious money, your long-term wealth-building funds, and for UK investors, that means your ISA, your SIPP, that must be ring-fenced for disciplined, properly researched investing, not speculation.
Okay, that clarity is vital. Which leads us nicely into the next big challenge Graham tackles, dealing with emotions. Because the market, it can feel like a wild ride.
Totally. And Graham gave us this brilliant tool and analogy to help manage those emotional swings. He called it Mr. Market.
Ah, yes, Mr. Market. Okay, let's unpack this. You have to imagine you're business partners with this guy, Mr. Market, right? But he's a bit unstable.
That's putting it mildly. He's essentially manic depressive. Every single day he knocks on your door, and he offers either to buy your share of the business from you or sell you his share.
Okay.
But the price he quotes depends entirely on his mood that day. Some days he's incredibly optimistic, euphoric even, sees blue skies everywhere. On those days, he'll offer you a ridiculously high price for your share.
Right. Seems like a great deal, maybe.
Seems like it. But other days, he's in the depths of despair, absolutely convinced the sky is falling. And on those days, he'll offer to sell you his shares for pennies on the pound, just desperate to get out.
Okay, so he's all over the place. What's the trap here?
The psychological trap, and it's a big one, is that most people let Mr. Market's moods dictate their moods and actions.
Right. So when he's euphoric, they feel great too and buy high.
Exactly. They get swept up in the optimism. And when he's panicking and prices are crashing...
They panic too and sell low, locking in losses.
Precisely. They let his irrationality infect them.
But the intelligent investor approach flips that completely.
Completely. The key insight is you are in control. Mr. Market works for you, not the other way around. You don't have to trade with him just because he showed up.
You can just ignore him.
Absolutely. You're free to ignore his daily offers entirely. You only engage when his mood offers you an advantage. You use his irrationality.
So when he's panicking and offering those super low prices...
That could be a great opportunity to buy more of a good business you already understand and basically getting it on sale.
Because you know it's real value, unlike him in that moment.
Exactly. And when he's euphoric, offering crazy high prices, well, maybe that's a chance to sell if the price is far above what you think the business is worth. But the point is, you're never forced to. You decide.
If we connect this to the bigger picture then, this whole analogy is about teaching us to separate the actual value of what we own.
The underlying business reality.
From the day-to-day noise and emotion of the market price.
Spot on. It's about emotional discipline.
So thinking about this for yourself, what does this mean for how you react to those big news headlines? Market surges, market dips. Are you letting Mr. Market get inside your head?
It's a constant challenge, isn't it, maintaining that objective view?
Definitely. And if you can stay objective, if you don't let Mr. Market dictate terms, then you're in a position to use another of Graham's key ideas, maybe his most famous one.
The margin of safety.
Yes. Warren Buffett called these the 3 most important words in investing. What exactly is it?
It's actually a pretty simple concept at its core. The margin of safety is a difference between the intrinsic value of a business, what your thorough analysis tells you it's genuinely worth, and the price you actually pay for its shares in the market.
So you're basically looking for a discount.
Essentially, yes. Graham insisted a true investor never pays full price, or what they perceive as full price. The article uses a good example. If you figure out a company's shares are reasonably worth £1 each,
Okay.
you wouldn't buy them at £1. You'd only buy if the market, perhaps Mr. Market, in one of his gloomy moods, is offering them for, say, 70p.
Right, so that 30p difference.
That's your margin of safety.
It sounds simple, like you said, but why is it so incredibly important?
Because the future is uncertain. No matter how good your analysis is, you might be wrong. Things happen, bad luck strikes, unexpected events occur.
Like a pandemic or a war.
Exactly. Or maybe you just made a mistake in your calculations. The margin of safety acts as a buffer, a cushion. It protects you from significant losses if things don't turn out exactly as you planned.
It protects you from the unknown, really.
That's a great way to put it. It's powerful protection against the inherent uncertainty of investing.
Okay, that makes a lot of sense. So for an everyday investor here in the UK, how do we actually get this margin of safety? What does the intelligent investor mindset suggest, practically speaking?
Well, the article points to 2 really effective, accessible methods for most people. The first one is diversification.
Not putting all your eggs in one basket.
Exactly that. It's probably the easiest way to build in a margin of safety. Instead of trying to pick the one perfect stock, you invest in a broad range of companies. Think about a low-cost global index tracker fund.
Right, the kind you can easily hold in an ISA or SIPP.
Precisely. You end up owning tiny pieces of hundreds, maybe thousands of companies across the world. If one or even several fail, it doesn't wipe you out because their impact is diluted. That's a structural margin of safety.
Okay, diversification. What's the second method?
The second is pound cost averaging.
Investing regularly.
Yeah.
Like putting a set amount in each month.
Yes, investing a fixed sum of money at regular intervals, say £200 every month, automatically. This provides a different kind of margin of safety. When the market falls, your fixed £200 automatically buys more shares because they're cheaper.
I see. So it lowers your average purchase price over time.
Exactly. You end up buying more shares when prices are low and fewer when prices are high, without having to time anything. It smooths out the bumps and provides a safety margin against buying everything at a market peak.
So 2 practical tools. Diversify widely And invest consistently.
For most individual investors, those are the most reliable ways to implement Graham's margin of safety principle.
It makes you think, doesn't it? How are you listening now, building that cushion into your own investment strategy? Are you diversified? Are you consistent?
Crucial questions.
Now, Graham also believed it was really important for investors to figure out which type of investor they are. He split them into two camps.
That's right. The defensive investor and the enterprising investor.
Okay, tell us about the defensive one first. What's their goal?
The defensive investor's primary aim is simply to avoid serious mistakes or losses. They want safety and, importantly, freedom from constant effort and decision-making.
So low maintenance, peace of mind.
Pretty much. For them, Graham recommended a really simple portfolio. Back then, it was often a split, maybe 50-50, between high-quality bonds and a diverse range of stocks.
And today, that diverse range of stocks would likely be
Almost certainly a low-cost, globally diversified index fund. Keep it simple, keep it broad, keep costs low.
okay, that's the defensive investor. What about the enterprising one?
The enterprising investor is different. They are willing and, crucially, able to put in significant time and effort. They're doing deep research, selecting individual investment stocks, maybe bonds, aiming to get better than average returns.
So they're trying to beat the market.
Essentially, yes. But Graham stressed this requires genuine skill, real discipline, and the right emotional temperament. You basically need to operate like a professional analyst.
That sounds demanding.
It is, and this leads to what the article calls a major psychological trap. The biggest danger is being a defensive investor. Someone who really wants safety and simplicity, but who tries to act like an enterprising one.
How does that look in practice?
It looks like dabbling in picking individual stocks, maybe based on a tip from a friend, or something they saw in the news, or just a gut feeling, but without doing the hard, rigorous analysis that the enterprising approach demands.
So getting the potential downsides of stock picking without the proper groundwork.
Exactly. And the article is pretty blunt. This almost always leads to poor results.
So the question for you, the listener, is, are you being truly realistic about how much time you have, your actual analytical skill, your emotional reaction when things go wrong?
That self-honesty is key.
It requires a real mindset shift, doesn't it? Being honest with yourself. The article even suggests that for, over 90% of people, the answer to, can I be a successful enterprising investor, is probably no.
That's the reality for most. And there's absolutely no shame in that. In fact, acknowledging it is the intelligent thing to do.
So connecting this to the bigger picture again. For the vast majority of us here in the UK, the smartest path is likely the defensive one.
Absolutely. Adopt a simple, low-cost defensive strategy. Invest consistently in diversified index funds. Hold them for the long term. That's usually the most intelligent and effective route to building wealth over time. It's about choosing the right game plan for your life.
Okay, this has been fascinating. Let's try and pull these threads together now. What are the absolute key takeaways from the article, pulling Graham's wisdom into 2025 for UK investors?
Right, let's summarize the big ones. 4 core points really stand out. First, invest. Don't speculate.
Use your ISA, use your SIPP for owning businesses long-term, not for quick bets.
Precisely. Second, control your emotions. Learn to ignore Mr. Market's daily moods.
Treat panic as an opportunity, perhaps, not a reason to join in.
You got it.
Yeah.
Third, build a margin of safety. And for most of us, the easiest, most effective ways are broad diversification.
Global index fund.
And consistent, regular investing, like pound cost averaging.
Okay. And the fourth?
Fourth, be a defensive investor. Unless you have the time, skill, and temperament of a pro, accept that trying to beat the market is usually a losing game.
Embrace market returns through a simple, low-cost, diversified, long-term approach.
That's the essence of it for most people.
So wrapping this up, what does all this timeless wisdom mean for you navigating your finances today? This deep dive really shows that the intelligent investor isn't about complicated spreadsheets, is it?
Not at all. It's about psychology. It's about discipline. Its enduring genius lies in showing that investment success is grounded more in your character, your mindset, than your IQ.
So the final thought to leave you with, by working on that mindset, cultivating patience, getting a handle on your emotions, resisting that temptation to speculate, and always insisting on that margin of safety, you really can navigate today's complex markets using the same principles that have guided the best investors for generations.
It truly does offer the most reliable path we know to achieving long-term financial security and freedom.
Maybe think about which one of these timeless principles you'll focus on incorporating into your own financial journey starting today.
And just to reiterate that important disclaimer from the start, and as the article also reminds us, This discussion was for informational and educational purposes. It's not financial advice.
Absolutely.
Remember, the value of investments can go down as well as up. You might get back less than you put in, and past performance doesn't guarantee future results.
Tax rules can change, and your situation is unique.
Exactly. So if you are unsure about any investment decisions, please do seek independent, regulated financial advice that's tailored specifically to you.
Couldn't agree more. Okay, if you found this episode helpful, please do like it, maybe leave a comment, share it with someone who might benefit.
And subscribe to stay updated with the latest insights from us here at the Plouta team.
We'd genuinely love to hear from you too. Share your thoughts or any questions in the comments below, especially if you've tried applying any of these grand principles yourself.
Yeah, let us know how it's going. Thanks for tuning in.